everybody. We are now officially on the record, so please behave. A couple of more minutes. At least here in Chicago, it feels like we went from winter to summer in about 4.5 minutes. I haven't used my backpack in a week and a half, and this morning when I opened it up, there was a scarf and gloves in it. And I walked out the door and I started melting immediately. So hopefully other people are having a better spring. I'm going to give it one more minute as people join in here. Okay, well, why don't we have this conversation get started? Because something tells me we're not going to be lacking in content or in input or questions with the folks that have registered for this. Good morning or good afternoon, everybody. I am Horacio Mendez. I'm the President and Chief Executive Officer of the Woodstock Institute. Happy to host everybody today for this informal conversation. We've had a couple of these on different topics, and one of the things that I'm starting to realize is in our work in community and economic development, fair lending, we get to have a lot of really interesting conversations with peers and partners that helps inform our position on a lot of important issues. More often than not, these conversations are individual, where we just give somebody a call and just say, hey, Sharon, I'm scratching my head over this, let's talk about it. Sometimes they're in groups. It could be on the side of a conference or during a Zoom conversation, but they're really substantive conversations. And I always learn so much from the people that I get to work with, and they're rarely shared to a broader audience. And that's a bit of a disappointment to me, given how much experience and how informed the opinions are of the many people in our industry we get to work with every day. And I'm sure I'm not the only one that feels that way. So we have too much to offer, not to share in some of these more interesting and salient conversations. So that is a little bit of the genesis behind some of these brown bag lunches we've had. So that's the reason as to why we're here today, because over the course of the last 1.5 years that I've been in this role at the Woodstock Institute, I have now officially been on every side of bank mergers, from managing protested merger applications while at the Federal Reserve, being an acquirer while I was an executive at 2 global banks, and now as a community advocate. And for the first time in my career, I can actually now ask questions in public without being fired. But these are questions that have been in my mind for decades about the whole process surrounding mergers and acquisitions and protests and the negotiations behind the development of community benefits agreements. And I think when you boil down to its core, the question can be summed up quite simply: is what we're currently doing really the best we can do, given the outcome that we'd like to see? And I've had this conversation with the folks that are on the screen with me here today that I'll ask to introduce themselves. And the feedback was really informative, and sufficiently so that we just decided to say, hey, why don't we have this conversation in public and share it with some folks and see what they think. So for the time being, I would ask each of you to mute yourselves and ask your questions on the chat as we go along, and we'll try to address those as we can. And then hopefully if we have a little bit of time before 1 o'clock Central, we can have like an open Q&A for thoughts or comments, etc. But for the time being, why don't we get started here, and helping me think through the answer to that very lofty question are 4 individuals that I've turned to as experts in various aspects of this questions. I'm going to ask each of them to introduce themselves, what they do, and their history with the financial industry. So I am going to start with the person that's next to me on my screen, which is Amy Nelson. Amy.
Thank you. I'm happy to be here. I'm Amy Nelson. I'm the Executive Director of the Fair Housing Center of Central Indiana. The Fair Housing Center is a nonprofit advocacy-based organization looking to address housing-based discrimination. So you're going to hear more about it today, but we have at different times filed enforcement actions against lenders who we have alleged are not following fair lending laws as well as other laws.
Okay, great. Thank you, Amy. Elisabeth, you'll go next.
Everyone, my name's Elisabeth Risch. I'm the new Executive Director of Housing Opportunities Made Equal in Greater Cincinnati. Similar to Amy, we're the fair housing organization in the Greater Cincinnati area, but I've been on the job for about a month. I came from the Fair Housing Organization in St. Louis, the Equal Housing and Opportunity Council, where for the last 12 plus years had worked with our Fair Lending and Community Reinvestment Advocacy Coalition in St. Louis called SLECRA, where we also were commenting, Horacio makes fun of our name all the time, we're in good company. But despite the name, we're a very powerful coalition that had been engaging with banks around CRA and fair lending issues. We provide comment letters and had negotiated a number of CBAs with local St. Louis banks.
Great, thank you, Elisabeth. Best group ever, worst acronym ever. So it kind of balances it out, kind of the yin and yang of things. Sharon, all the way from Alaska, thank you.
Yes, I'm on half vacation, so that's why I'm up in Alaska. But my name is Sharon Lagenza, and I'm the Executive Director of Housing Action Illinois. So I'm really Illinois based. And Housing Action Illinois is a statewide coalition of over 160 member organizations working to make sure that everyone has a safe, decent place to call home. And I'm a lawyer by training, and I've done fair housing cases myself. I spent 10 years at the Chicago Lawyers Committee for Civil Rights as in their fair housing project. So I'm familiar from an enforcement side what happens in terms of fair housing and fair lending. But more currently, Housing Action Illinois, we really work to build community and to build relationships between our community members. Not from our community-based organizational members and financial institutions, because our mutual goal is to make sure that low and moderate income communities and communities of color are best served. And so that's kind of the approach we take. And I've sat on different advisory councils in the past and currently, but that's kind of our approach at Housing Action Illinois.
Okay, great. Thank you, Sharon. And last but certainly not least, Senator Calvin Bradford, board member of the Woodstock Institute and longtime partner. If you can unmute yourself and introduce.
Hi, my name is Calvin Bradford. I started working with community groups in Chicago in 1972 who were fighting redlining, and later formed National People's Action, which is the main group behind the creation of HMDA and the CRA. And I was on the board of their organization for a little over 20 years. So I helped with the group with developing the legislation for HMDA and the CRA. I've evaluated CRA performances. I've participated in challenges. I've worked for the banking industry on the side, and I do a lot of fair housing expert work, fair housing and lending expert work for particularly fair housing groups I see here around me. And right now I'm lucky enough to be able to work with a group in Illinois People's Action, which works on environmental and community economic growth issues. And so I keep doing that.
Great. Thank you, Calvin. So I think you all see why I've turned to these four individuals when I have questions about what we're doing, how we're doing, and what we want to get out of this. So Elisabeth, why don't I start off with you? But before I do, I hope, we're all hoping that the transition from St. Louis to Cincinnati was relatively painless, that you're settling in nicely in your new role there at home. So why are we having this conversation at all? What's going on that continues to make this so timely?
Yeah, so I think, we've all noticed an uptick in mergers recently. So there's been a big consolidation of banks over the last kind of couple years, from very small local regional banks kind of buying up other small regional banks, from very big banks merging. And I think, my perspective as a CRA advocacy coalition, we saw those mergers as an opportunity to really engage with CRA and fair lending laws and saying, hey, what are you doing? What have you done as a bank? And then what are you going to do as this new kind of larger, bigger organization or institution? And kind of taking the approach that when a bank does merge, there has to be some sort of public benefit associated with that. So taking kind of that regulatory framework, how it's supposed to be designed to say, well, when a bank merge, there needs to be some sort of benefit to the community. Yes, they have to meet their CRA obligations, but we're also looking for something kind of in return. And so our coalition in St. Louis started to kind of see a lot of mergers, as many of my counterparts on the call did. And we started doing our kind of typical bank analysis, looking at what the bank had done. And, you know, not surprisingly, we saw a number of issues, fair lending issues, CRA issues where banks were just not meeting their obligations, very low lending to Black and Latinx borrowers, branch locations in predominantly white upper income areas. Kind of years ago, about, well, some I think are still doing this, but assessment areas that really excluded communities of color, pretty blatant fair lending and redlining violations. And we took that approach and said, well, wait a minute, we should not be supporting these bank mergers if there's pretty clear violations of fair lending laws. And so we used some of our kind of levers that we have available, like protesting the mergers, commenting to say we should not allow this merger, and then really kind of trying to work with the bank to develop what we saw as kind of meaningful changes. And so I think, you know, some of your questions, Horacio, over the last year or so, since you've been in your role and we've done some work together on one particular bank campaign with First Mid Bank and Trust out of Illinois, kind of buying a local bank in St. Louis, was really like, well, what is this kind of CDA goal? Yes, we can protest the merger. We can, you know, kind of raise the red flag of fair lending violations. But at the end of the day, my coalition members and our community members wanted to see some real meaningful benefits. And so to us, that was really engaging with the bank in a community benefit agreement that was significant, real, meaningful, had tangible, measurable kind of benchmarks in it where we could continue to engage with them to see changes. And so we see that as new products, investments, loan products, branch locations. And also, I think, you know, I hope we can have this discussion today about some of the intangible benefits, like culture change at a bank, of a bank coming from a different place to then saying, oh, we do care about the community. We want to kind of be proactive. And I think all of that kind of, you know, there's a lot of tension. There's a lot of tension with that about how we get to those places, kind of within our advocacy, within our nonprofit sector, but also as we kind of work with institutions to get to that point, which is where I think a lot of this conversation today is coming from, is kind of that push and pull of what are we actually getting from the bank? Yes, it's not very much on paper, but are there other benefits? And I think, yes, there are.
Okay, great. Thank you. Sharon, Amy, or Calvin, anything to add before I ask my next question?
Well, I'll just very briefly, I think something that I was going to touch on, but I think it falls here, which is that I think the tension is always between being too transactional, right? That, you know, we do look at numbers and wanting the loans and wanting the investments, but not it just being transactional. And how do we get to the relational aspects of these community, what we would hope to be community partnerships? And that's kind of one approach to think about is, you know, what are needs in communities and how do we get bank leadership to really understand that and adopt that?
Great, thank you. So it looks like we have a couple of different tools to use. And one of them can be that negotiating tool that has been commonly referred to as a community benefits agreement. Calvin, I jokingly introduce you to many of our partners as Fair Lending Yoda. And every conversation we have feels like a TED Talk where I need to record it and take notes. Can you help us understand where CBAs came from and how they're monitored or how they were monitored or enforced?
Yeah, I think in order to understand the background, and I think it's still relevant today, I think we need to understand the context of where the anti-redlining movement came from and where HMDA and the CRA came from. Because at that time in history, the mortgage markets were actually the result of New Deal credit allocation policies. And so there are two powerful policies I think we need to understand. The first is in credit allocation, FHA loans provided mortgages that were 100% insured, but these were made by independent mortgage companies. They were sold to investors who were protected by the insurance, and the mortgage companies made money originating the loans and servicing the loans, and they even made money foreclosing on the loans. And second, conventional loans, which were not FHA loans, were largely made through savings and loan associations, not through commercial banks. And that's because the government had a policy where they required 80% of these savings and loans to put their money into residential mortgage loans. And they also allowed savings and loans to pay a higher interest rate on their deposits. So this is pure credit allocation from the New Deal to support the mortgage market. The other important policy is the federally endorsed policy of racial discrimination, racial redlining. And that was officially part of the FHA loan process. And it was a part of the conventional loan process too, because it was developed by the professional appraisal industry and incorporated into the conventional underwriting standards as well. So back in the late 1960s and early 70s, community groups began to experience massive levels of foreclosure in their neighborhoods. And that was a result of the fact that after the urban riots and the growth of the civil rights movement, FHA literally reversed its redlining practices, and it gutted its underwriting standards in order to make loans in minority neighborhoods. And the result was massive levels of fraud and foreclosure, lack of monitoring of these lenders, so that these neighborhoods were collapsing, full of foreclosure and abandonment. Meanwhile, the savings and loans continued their redlining policies, so they didn't change their practices. So you had this dual financing system. So there was a two-pronged approach that neighborhood groups, when they formed National People's Action, a national coalition across the whole country from neighborhoods that were suffering. One approach was to, stop the fraud and abuses from FHA. And the other approach was to get the conventional lenders to make sound loans in their neighborhoods. And that's where HMDA and CRA were directed, not at FHA, but at that time, savings and loans. And CRA still only covers depository institutions. But meanwhile, we have to understand, I think national policy has changed and was changing at that time. And deregulation was the large move for the financial industry. And therefore, credit allocation was clearly anathema, both to the regulators and to the banking industry. So if you note in the law, even though the law says banks are required to serve their neighborhoods and fully serve their neighborhoods, you'll notice that the CRA says that the role of the regulatory agencies is to, quote, encourage, not require the banks to meet these regulations, because that would have been, in their minds, credit allocation. And the regulators at the time assured the banks that there wouldn't be any form of credit allocation and it wouldn't be too hard to pass the CRA. So the community activists already realized that there wasn't going to be strong enforcement, and they actually started making agreements before there was even HMDA. And that was largely through the creation of neighborhood housing services programs across many, many cities in the country, beginning in 1974 from the Pittsburgh model. And as it became more and more clear that the regulators weren't going to enforce these agreements, the National People's Action engaged in massive amounts of training. They wrote guidebooks, they encouraged people to train. They wanted to create the capacity all across the country for people to negotiate agreements. And at the time, these were Community Reinvestment Act agreements. I'm not sure at what point they became community benefits agreements. And as deregulation increased and there were more and more covered applications and mergers, these agreements focused on banks as well as the savings and loans. And the capacity of the local groups to negotiate these agreements increased, the sophistication increased. And so they expanded the range of things that were included in these agreements, not just mortgage loans, but branch locations, loan counseling, marketing, Special loan programs, multifamily lending. I see Jamie Weisberg's on the call. And one of the second agreements in the whole country was for multifamily lending in the Bronx. Mixed use property lending, all kinds of more diverse programs. As the challenge became more sophisticated, however, the regulators adopted this notion of conditional approvals. So they would essentially say, we're approving the merger, but the lender has got to pay attention to these charges. And while I now understand from Horatio that at least somebody in San Francisco actually looked at these agreements, the regulators had an official policy of not enforcing these agreements because that would have been credit allocation in their mind and of course in the mind of the lending industry. So even though they said that there was a conditional approval, there was no enforcement to follow up by the regulatory agencies. So essentially a conditional approval simply became an approval that ignored the complaints. The general outcome, I'd say, was the upside of all this was that many community agreements resulted in much more that could have been achieved by simply a denial. If they had the denial, there'd be nothing going on. The CRA agreements could create a whole wide range of reinvestment programs. The downside was, of course, the government didn't enforce the CRA to any great extent. And it really meant that you had to have community groups with capacity to create these agreements. Otherwise, in your area, there wouldn't be anything happening. And finally, the question is, what happened to race? Because initially, it was all about race. But when Proxmire developed the language, he didn't include race, even though the National People's Action was very forceful that they wanted it to be included. Because race wasn't included, you found that the CRA agreements really began to focus on low moderate income communities and then larger communities. And that actually in the long run became an upside because it made the coalition base larger. It included farms, areas of rural, small town lenders. It included all kinds of low moderate income communities. So in some ways, even though it ignored race, it made the range of diverse activities, the community base and the activities in the agreements much broader. There weren't lawsuits in the beginning, and that's largely because community activist groups didn't use lawsuits. They just went to people's homes and demonstrated and forced the bankers to make these agreements. So it wasn't until later on when you had a lot of fair housing groups and civil rights groups that joined the movement that you began to have these lawsuits. And again, the settlement allowed you to create a wider range of programs than you might have gotten with just a jury verdict in a particular case. So I'd say finally that today's issues that we have is that this CRA still fails to consider race. It's just not included. They claim it's included, but it's a sort of a footnote. And reviews of the CRA agreements that I've made show that they basically ignore racial discrimination, or they maybe lower someone's score, but not to a failing level. And we've got deregulation again. So the credit allocation again is going to be a major issue, particularly in the politicalization of our country, where the right wing is going to claim that all this stuff is credit allocation. So I think that's pretty much where we are right now.
So now I think you guys see why I always feel like I need to record my conversations with Calvin. It's a lot of really good information and very densely packed. Thank you for that, Calvin. So transitioning then, it seems like we have two sticks as an industry. One has a little bit of honey in it, which is we have to use the stick to protest an application and bring the banks to the table and talk to them. And then kind of go through some form of therapy where we come out with some kind of functional relationship. The other step might be a little bit bigger and there's no honey to it, and that's judicial action. And Calvin, you mentioned that initially there wasn't a whole lot of that. People just like showed up to somebody's lawn and started protesting, which I'm not, I know Rainforest Action Network did that to one of my CEOs in the past, and that was quite effective in giving me the resources I needed to deal with it. But not always something that goes over too well. So I'm wondering whether or not we could talk a little bit about that bigger stick. Sharon and Amy, I know that this is on the fair housing side of the conversation, but I'm wondering whether or not the two of you can talk a little bit about where is that line where you feel like at a certain point, legal action is justified? What needs to be done in order to lay the foundation for successful legal action if you feel that an institution is discriminating in such an egregious manner that that kind of stick needs to be used, and why that stick and not if there's a merger and application at the same time, why not simply a protested application? So I'm not sure who I should start with that with Sharon or Amy, but I'll let either of you kind of jump in. Maybe Amy?
So there's a lot there, and the quick answer is it depends, is the quick answer. So for many of us organizations who are trying to challenge these practices, we are likely smaller nonprofit organizations trying to work at the grassroots level, and simply, do not have the resources to move every single case that we think might warrant it forward into judicial action. We may struggle to find attorneys in order to move forward simply because these might be cases that stretch out 5-7 years if a defendant really pushes back or doesn't want to come to the table. We have some cases here at the Fair Housing Center that go back 10 years right now against a couple lenders where we have challenged some practices with some other fair housing groups across the country. So there's that aspect of it. It's the amount of time to put together these cases, which may need to have a variety of type of investigative methods in order to make them as strong as possible. A review of data, mapping that goes into it, bank branch review, looking at the HMDA data, fair housing testing being conducted, looking at CRA exams, variety of different things to determine whether or not you may have a viable case in moving forward. You may try to meet with these defendants to try to do some pre-filing negotiation, or you may not choose to do that. You may have a receptive response. You may not have a receptive response, which then may determine, how you go forth in doing that. It's very much, a resource issue. If we had enough staff here at the Fair Housing Center, we would have filed probably half a dozen more cases already, but the amount of time that has to go into these cases just takes up a lot of staff time when you're also doing rental work. You want to do insurance and sales work. We're doing appraisal work. There's zoning that's out there that needs to be, challenged as well. So then when there's an opportunity, when a merger is announced, that may be a time period when you have some additional leverage with that lender to be able to get them to move faster than a long drawn out litigation may warrant, or that may not be successful either, but it might be something that allows some additional leverage to try to make sure that lender enters into some sort of agreement that you feel is going to be very proactive and healthy for your community or neighborhood. I will, say, I'll just finish up my comment here and turn it over to Sharon, is that I used to be the regulators need to be doing their job. This can't fall upon nonprofits in order to be addressing this. And unfortunately, I've kind of settled into our regulatory agencies have just become so politicized that depending upon one administration to the other, they may or may not do lending work. And so I kind of have settled back into HUD, Department of Justice, those type of organizations need to be providing enough funding to nonprofits so that they can then carry this weight or carry this burden in moving forward and addressing these actions and providing us with the resources, because we're not as dependent upon the administration and as how we go forth in private litigation.
Wow.
Yeah, and I would just echo that. Bringing a fair lending case or any sort of impact fair housing case is incredibly resource intensive. because you need to make sure that you have the evidence and the facts in line, because the worst thing is to go forward with a weak case potentially and, lose or make bad law or waste resources, and no one wants that to happen. But the other point I would make is, the fair housing centers do amazing work, but they're not everywhere, right? And they can't be everywhere. So there are broad areas of the state of Illinois where there's not a fair housing center located, for example, although different fair housing centers will do work and accept referrals and things like that. And that's true across the nation, right? It's not just an Illinois issue or an Ohio issue or an Indiana issue. It's across the nation where there isn't enough resources going to fair housing enforcement centers. But I'll also say this from my experience. So, I was a litigator for about 15, 18 years of my career, and I had a number of impact cases that lasted 8 to 10 years, and then we would settle. And the settlements were good. The clients got relief, and we changed some policies because these were system level cases. But then I realized, like, after all of that, and at the same time, communities are suffering, individuals are suffering. So I thought, oh, well, let's go on the policy side, which is what Housing Action Illinois does, being too naive to realize that also take decades to move things sometimes. But I think we need all of the tools, right? Definitely we need enforcement action and we need litigation, but I think CBAs, some of the, I think, intent behind them was this idea that we can't litigate our way out of this problem, right? The bad actors, though, we do need to treat differently. The regulator should treat them differently, and community groups should treat them differently. But we need to have the resources to be able to come up with that data, to have at least some baseline evidence, right, to know that they're the bad actors. But there are some, banks who merge, who are, really try to be good community partners, however we define that. And, I think that something that Horacio and I have talked about is that I think those CBAs can be useful in bringing leadership to the table, in, kind of having more conversations about community needs. But it's not a one size fits all. And I think, unfortunately, we've kind of defaulted to CBAs because of some of the resource limitations, although again, there's individual cases where things are happening and moving and there's more enforcement potential.
Yeah, thank you for that. Elisabeth or Calvin, any comment on that before we move forward?
I just say, I think when I've been reviewing the CRA agreements, I found at least 15 cases where major banks were sued by the Justice Department or HUD or someone for fair lending violations after they were given high marks on their CRA performance. And the little section in the CRA review says, we found no illegal activities, which obviously is not true. So I think, one thing I've pushed very hard for is that race needs to go into the CRA, directly being considered. And I don't think, and we have to approach the litigation issue, the racial issue, as not being about credit allocation. It's about making people whole who were discriminated against. So that's not credit allocation. That's the way our legal system works and should work properly. And I think we need to press the agencies about why it is they don't recognize these fair housing cases and why they don't find these fair housing cases when they do their own analysis. The only time I've seen them retroactively lower the score was when the Justice Department or HUD sued them. But even in cases like where the entire city of Baltimore and Memphis settles an agreement with Wells Fargo, they don't even recognize it. It existed, it didn't even exist. And when the fair housing groups do it, it's never mentioned. So it's like it only counts if they're either it's in the media and somebody in the New York Times embarrasses them, or it's a federal agency. And that's an absurd kind of approach. And the last thing I'll say more largely is, rather than just the opportunity to intervene when there's an application, in 2010, National People's Action, and Don Carlson knows this, filed complaints against Wells and Bank of America for discrimination as well as other things, and said you should lower their score because they failed. They did the wrong thing. And we were told by the comptroller that you can't lower the score after it's been put out there. And now as I review the cases, Bank of America, a terrific example, twice after the CRA evaluation was already given, they went back and lowered the score when justice sued. So they lied to us. And it seems to me that that gives you another opportunity to intervene without waiting for all these mergers to take place, because they've set their own pattern that shows that you can lower the score later. And they have to start recognizing what citizen groups are doing.
And I would just like to chime in on that too, is that also what Cal mentioned about not completely making, the communities impacted whole is just so critical. We see in a lot of settlements, for instance, by Department of Justice, where it appears, at least to me, only speaking to myself, is very often what they're trying to do is just get the lender where the lender should have been. And there's no payback to all those years when the lender wasn't doing what they should have been doing. It's about just getting them where they should be. So it's loan subsidies, it's things like that. It might be a bank branch, which is pretty rare in a DOJ, case. It's a loan origination. So, but there aren't. It might be a civil penalty, which of course goes back to DOJ, instead of DOJ fighting for those dollars to go back into neighborhoods in a way above and beyond a loan subsidy or loan origination, or now special purpose credit programs. So I think that there needs to be more of that being done that I just haven't been seen at the Department of Justice level in their cases.
So it would seem that the Interagency Council of Regulators, the FFIEC, the Federal Financial Institutions and Examination Council, is not necessarily creating an environment in which financial institutions are being held accountable on fair lending the way that we would expect them to. The resources for the industry outside of the regulatory agencies to be able to regularly monitor the industry is non-existent. So really, when an application or a merger announcement comes around, that's the only time we ever really take a look to see whether or not there's anything to examine. And in some cases, it may be so egregious, to your point, Amy, that says, okay, yeah, this qualifies as something that we can sue over. Or in other cases, Elisabeth, this is something that gives us an opportunity to sit down with the bank and have a conversation. Calvin, to your point, that doesn't do anything to undo the damage that was done for the decades that probably existed before that merger or application even showed up. And all that damage basically gets washed under the table after a settlement or a CBA gets written into place. And even if a CBA is put in place, from what I'm hearing, there's really no enforcement. It's not like, I'm sorry, Bank of America, you're gonna have to, I'm sorry, Nations Bank, you're gonna have to put Bank of America Bank on the market because you didn't deliver on all the CBA promises that you made. That's never gonna happen. So now let's talk about, kind of that consolation prize. And Elisabeth, I was really impressed with the work that you did in bringing together your coalition in St. Louis when Woodstock was able to help a little bit with regard to some of the data and the conversation. And sitting down with the financial institution's executive team. And what's the approach? Because I think we both agreed that the data was bad. I mean, and we were kind of upset that they'd gotten away with this for so long. But then at the meeting, it was very collegial. And there was, you had sort of two different personalities. You seem very nice, but I've come to the conclusion that I don't want to cross you. Because at some point you kind of drew the line and say, okay, here's what we expect. How do you manage those conversations, and what's your approach in building a coalition to have that CBA conversation with the bank?
Yeah, and I think, this is something that Sharon touched on too about, there is a difference in how we engage with banks if there are, lawsuit worthy data or experiences. And then there are some banks, where they're bad, like the data is bad, but it doesn't, rise to the level of a fair lending lawsuit, or, to Amy's point, there's not kind of that vehicle through HUD or DOJ that would even kind of do anything. And so that's where I think really kind of this strong like organizing and organizing a coalition comes into place, not just to start having the conversation with banks to show them that we're serious and that they need to change, but then to kind of get into the meat of here's what we want done differently. And that's where I think, you know, learning skills about negotiation, kind of mapping out what's possible. I think there's a lot of capacity building to do within our industry about what is possible at banks and what kind of financial institutions can do. And you know, that's likewise for banks need to learn about what's possible in our community. Yes, they can open a bank branch and it's going to be super profitable in 5 years if they do it right. And so that kind of like, you know, conversation and relationship building takes a lot of time and effort. And I think you have to look at some really good examples from around the country about what benefits we should be asking for. So I think it's always, you know, in St. Louis, we always were looking at other examples of what, you know, what things could we ask for? You know, it's now special purpose credit programs. Let's talk about that with banks to really target kind of some of the populations that have been blatantly excluded from financial industry and now more subtly excluded. It's, you know, bank branches and what types of bank branches can be opened. And so I think, you know, I don't know that there's like a, you know, a tip for how to like negotiate with banks besides just learning how to negotiate and how to build a strong team with you so that it is, you know, you're kind of balancing the asks and putting forth kind of a united front too, I think is important.
Yeah. The one of the things that I was surprised by when I left the regulatory agency and went to the banking side of it is in many of the mergers and acquisitions we were going through, a CBA type line item was included into the budget. It's become part of the process of mergers and acquisitions. Let's see how much it's going to cost us and what we can do to sort of make the protests go away and get the approval we want from the agency. And even with that, we still seem to have the same issues in the industry. What is your feeling, and I'm opening this up to the entire panel, and at this point, if people have a question they want to ask, please raise your hand. Do you feel like CBAs and the process associated with them are helping to change the culture of the industry, even if it's slowly? Or do you feel a little bit like this is just one of those checks that banks cash as part of the process to sort of make the noise go away? And I open this up to the entire panel here. Anyone want to be the first courageous one to try and answer to that?
Well, I think they change in a sense that some things become standard that, you know, and you've got community development investments now that you didn't have initially. So different aspects have been put on it. But the problem with the CRA is it doesn't grow, and the proposed regulatory structure they're giving isn't going to grow anything either, because it looks at what the peers are already doing. So basically you're just held for what people have already traditionally done. And you're going to put a dollar amount on it or a number of loan amount on it. And then you're going to essentially teach to the exam of the banks to figure out how much we allocate so we can get to that threshold. So the creativity really comes from the community people who have historically expanded the range of things that are done and the impact of the things that are done. And I think a lot of that depends on sharing information, which we haven't talked about. But people need to know what everyone else is doing. And if someone, you know, negotiates an agreement in Indiana, and that bank has got a resource in Nebraska, then the people in Nebraska ought to be able to come in and say, okay, we get the same thing. So that people can piggyback on the expertise of other people, not as well as having their own expertise. Because historically, the creativity has come from the community, and I think that's going to always be there. And we need to somehow figure out how to maximize that stuff.
Anything to add from the other panelists before I ask some of the questions that are popping up here?
Yeah, I would say that You know, there's a cynical way to look at this, Horacio, which is that it's just a line item and you check the box. And I think that that does happen, you know, again, with some institutions, but some might be say, hey, this is an opportunity for us to engage differently. And it has become the kind of the model where at least kind of community benefits is, you know, added in, right? So I guess I'm trying to be a little bit like glasses half full right now. You know, knowing that we need big levers to move this system that's been around for so long, and with these, you know, large institutions in particular. But I would also say that this is like a kind of a plug, but there's an opportunity to comment on the federal rules, and as well as the state of Illinois passed a state CRA, and there'll be proposed rules coming out later on this year. So when we think about how do we engage community and how do we engage banks differently, you know, we'll have some opportunity to kind of maybe influence the framework for that. And that's what I'm hoping will come out of some of the work that we've done collectively.
So I'll also take a glasses half full kind of view. Yes, they might be kind of just checks in a line item to make us go away and stop protesting their merger. But I think the real meat of it comes to the implementation and the ongoing accountability with it, which I think as an industry, we're still learning. I think we've had a lot of issues and struggles with both the small CBAs and the big CBAs about how are we monitoring and continuously engaging with the banks as they say that they meet these goals. And I think we have a lot to learn from that. You know, our small CBAs kind of in St. Louis, it took a lot of time and effort to meet continuously with the bank and ask hard questions about what their numbers look like and what they're doing and how they're changing. And that takes time and resources and organizing. And I think that speaks to the capacity building that needs to happen for CRA coalitions, for local CRA advocacy groups. That's just, you know, that hasn't necessarily been kind of around or is starting to grow.
What is needed, and that's a great point, Elisabeth, that you know, the CBAs provide an opportunity for community organizations to talk to a financial institution in a manner that normally wouldn't happen. You know, even two organizations that are doing a good job in fair lending or community reinvestment coming together, it provides an opportunity for organizations to sit down and start imagining what could even be better. How can we daydream together and use this opportunity of creating a new, larger institution into something that can provide greater impact in the community? But what's needed at the community level to be able to sustain that? Because at some point, somebody needs to stay on top of that, right? Somebody needs to have the ability to maintain that coalition and have the bandwidth to be able to say, okay, well, it's time for us to talk about how you're doing. What's been your experience in terms of what's needed from a resource perspective? Is this something that nonprofits need to go out and fundraise for? Is this something that the agencies can help with? Because you guys already have, you know, your plate full with your day job. And then on top of that, if you have a number of institutions in your market, how do you stay on top of all of them, making sure that they're living up to the commitments that they've made over the course of the last 10 years? Any thoughts on that? Or
well, I don't have the winning formula on that because it is a struggle. I mean, that's the short answer, is that it certainly is a struggle. You know, half the battle is won when you enter into any type of agreement, whether that is a CBA or even a judicial one, because you've still got the monitoring and the potential follow-up and everything related to that. At least with litigation, you know, you have the court oversight if there are major disagreements. And so that can, you know, be a benefit from that aspect. But it's a tremendous resource strain of putting the cases together and getting that piece, then moving forward and getting some sort of resolution. But then there's the long-term monitoring that also has to happen with it.
Yeah, I think in the past, you know, when I've reviewed these agreements, first choice, the most successful thing is there needs to be a partnership for the oversight. not just a partnership with the money going out, but there has to be a committee, an organization that's the bank and the community that's monitoring this. It's got to be supported by funds to make that happen. And also that has a nice effect of creating support internally for the CRA people in the bank who are working on this, who are, as I've always said, staff people. They're never going to be the president. They're staff people. They're not in line to be president, but they need to have support too, because those people end up going out in the community and in many cases advocating all these programs because they see how they work and they see the value of it. So there's a two-way street there. And without that partnership, without the continual setting up constant meetings, monitoring meetings, reporting processes, you lose that. So I think that's an important thing that has to take place. And by the way, in the past, I haven't seen in years, I got a whole file drawer full of publications that the bank regulatory agencies created on successful reinvestment programs, how this program worked, how it should happen. And you don't see those anymore. They just sort of disappeared. You know, there used to be essentially support systems to the community and to the banks about creative programs. When a new program came along, this is new and different. And we're going to get in the future from the CFPB some really powerful business data. So we can go way beyond mortgage lending and start looking at a lot more things that need to be done in the communities. But we're going to need the resources to look at that information, and going to have to be some support for that.
Thank you. It sounds like maybe something that is needs to be a component of a successful community benefits agreement, because typically it does have funding associated with it for lending, but also philanthropic support, et cetera, is to be able to provide the resources necessary to have that infrastructure for oversight. To be able to have that as a foundation saying, okay, well, you need to pitch in to help us make sure that you're meeting your obligations. I know it may sound weird that way, but I know as having managed a number of CRA teams, we viewed a lot of these agreements as beneficial to the CRA department within the financial institution. It gave us objectives, it gave us clarity. It also ensured budgets into the future. Many people that are financial institutions that may be on this call know that the resources to CRA and foundation teams go up and down with regard to the administration of the financial institution, with regard to its budget. It's always nice to be able to have either a community service action plan or a community benefit agreement that says, this is what we expect to see from you over the course of the 10 years, because then that provides that team with surety of resources over the course of the long haul. So it's not just the community that benefits, but it's the bankers that want to serve that community that can benefit from this as well. But I think that's a layer that's important to include in these CBAs. So my final question, and I'm going to go to each of you with regard to sort of this vote. Are you for community benefits agreements as a positive tool towards community change? Or do you feel that there's a lot of value being left at the table and it needs to be reevaluated? I'm going to start with you, Calvin.
I guess my answer is both. They're certainly valuable because I really believe you can get more out of a benefits agreement than you could have out of a denial, even if you won a challenge. So, and they provide the creativity for the new programs, for extending the boundaries of what happens in the bank. So they're really valuable there. But they are a limited tool because we don't have the resources to expand them, and we don't have enforcement at the federal level.
Amy, what about you? What do you think?
I think it's a mix. I think that our position has been here at the Fair Housing Center of Central Indiana is that we will certainly sign on to CBAs when it's a lender who is, not the worst of the worst, or middle of the pack, or maybe performing well, and we will sign on in those cases. Or where we see that this is definitely something that's top driven. If the CEO cares, then typically that's going to reach the employees and we're going to have a positive outcome. We have certainly made the decision to not sign on to CBAs when it involves some lower performing lenders, so that we reserve the right that if that CBA is not adequately addressed, that we could come in potentially with litigation, at least serve our community in that particular case or complaint. So I agree with Calvin that they can be very powerful agreements when you are in a position that you might not be able to do litigation and a full-blown enforcement action.
Sharon, where do you land?
So I apologize, there's some background noise if you hear that. Yes and yes, right? I think, I do not believe that we could litigate our way out of this, right? I think it's an important enforcement option, but I think that we do have to have alternative tools, and I think CBAs are one of those. With that said, I do think that we have to approach it perhaps a little bit more stringently, but there are resource limitations that make it near impossible for community-based organizations to do that consistently and across the board and across all the geographic regions. And for that reason, I really think we have to think about how to engage the federal regulators, HUD, DOJ, kind of just really much more strategically, because we'll never be able to match the resources that they have to do what I feel is within their charter.
Thank you. Elisabeth?
No surprise, my answer is yes and yes. Yes, I think CBAs are valuable, and they need to be strong CBAs that have really clear, significant, meaningful benefits for the community that have been formed by community-based organizations and have those tools for accountability and implementation. So I think we sell ourselves short as an industry when we kind of take the lowest hanging fruit, that we should be kind of keeping our expectations high. And if an agreement, with a bank is lower than what we expect, or we're not willing to sign off on it, we should not sign off on it just for the sake of getting a CBA. But there still is value. And I think a lot of opportunity for us all to continue working on CBAs and learning from them and working towards really seeing them through.
Great, thank you. I was going to try to do a lightning round on what you guys thought would need to be reformed in the merger approval process, but something tells me we're going to need more time on that one. So with that said, I want to thank Amy Nelson and Elisabeth Risch, Sharon Legenza, and Calvin Bradford for sharing the conversation we've had a number of times with the broader audience. I hope you guys all found this helpful. I want to thank our 4 speakers for their time and their brain power, and I wish everybody a better spring than what we're having here in Chicago. All right, thank you.